Depreciation. You've probably seen that word on a financial report, right? It's one of those accounting terms that can make a company's profits look a little weird. But honestly, it's not as complex as it sounds. At its heart, it's just a story about how a company's big, valuable items get older. And if you can understand that story, you get a much clearer picture of a business's real health.
Okay, let's just dive right in with an example. Picture this. You own a bakery and it's doing great. You decide to upgrade and buy a beautiful, new, top-of-the-line oven. It costs you $10,000. Now, you know this beast is going to last you at least a decade, churning out delicious bread day after day. So, here's the big question. How do you account for that massive $10,000 hit? This is the exact problem depreciation was invented to solve.
All right, so you might be thinking, why not just call the $10,000 oven an expense for this year and get it over with? Well, that right there is what we call the big asset problem. If you did that, your books would tell a really misleading story about how your bakery is actually doing. And the reason that's a problem all comes down to a fundamental rule in accounting called the matching principle. It's actually a super logical idea. All it says is that you should record your expenses in the very same period as the revenue they helped you earn. You match them up. Think about our oven again. Is it only going to help you make money in the first year? No way! It's going to be baking bread and bringing in cash for 10 whole years. So it just wouldn't make sense to slam your finances with the entire cost in year one. You have to spread that cost out to match it to all 10 of those money-making years. So, if we can't just expense it all at once, what's the alternative? Well, this is where our solution comes in. Say hello to depreciation. It's the clever accounting tool that makes sure the financial story of your business is fair and accurate over the long haul.
Okay, so here it is, the official, kind of dry textbook definition. Depreciation is the systematic allocation of the cost of a non-current asset over its useful life. I know, it's a mouthful, but the key words in there, systematic allocation, cost, and useful life, are literally the building blocks for this whole idea.
But let's just translate that into plain English. All it really means is taking the big upfront cost of something, like our oven, and chopping it up into smaller pieces to spread across all the years it's actually working for you. The key here is that it's an allocation of cost, not a valuation of worth. That's a huge distinction. I love this quote. It really puts it all in perspective. A machine doesn't die suddenly. It dies emotionally first. Accountants just track it. It's such a clever way of saying that things don't just break overnight. They wear out slowly, and depreciation is just the accountant's way of keeping track of that slow, gradual decline on paper. Okay, so we get it. We need to spread the cost, but how exactly do we do that? Well, that leads us to our next big topic, choosing your strategy. Because it turns out not everything loses its value in the same way or at the same speed. I mean, think about why things depreciate in the real world. You've got the obvious one, simple wear and tear from using something every day. But then there's obsolescence, when a newer, shinier, better model comes out. Sometimes things lose value just because time is passing, even if you're not using them. All these different factors mean you need different strategies. Now let's look at the two most common ways to do this. First up is the straight line method. This is the simplest and most common. It's super consistent. You just take the original cost, you subtract what you think it'll be worth at the very end of its life, that's called the residual value, and then you divide that number by how many years you'll use it. For our $10,000 oven, maybe it has a $1,000 residual value and a 10-year life. That's a nice, steady $900 depreciation expense every single year. But then you have the reducing balance method. This one is front-loaded, so you have a bigger expense in the early years, and it gets smaller over time. This is perfect for things like company cars or computers that lose a huge chunk of their value the second you drive them off the lot. All right, we need to talk about something really important now. This is probably the #1 mistake people make when they think about depreciation. We're going to call it the market value myth. It is absolutely crucial to understand what depreciation is not. Okay, here's the trap. Most people think depreciation is just tracking how an asset's price is dropping on the open market. What you could sell your oven for on eBay. That is not it at all. The reality is, depreciation has absolutely nothing to do with market value. It is purely an internal accounting trick to spread the original cost of that oven over time. That's it.
So let me be crystal clear. Depreciation is not a secret savings account you're building up to buy a new oven down the road. It is not actual cash leaving your business, and it is definitely not a way to figure out what your used oven is worth today. It's just an entry in a ledger, a way to match cost with revenue.
So you're probably asking, okay, if it's not real money and it's just a number on a page, why should I even care? Because that number on a page has a very real impact on your company's bottom line. So let's look at how depreciation actually moves the numbers around.
First, let's look at the income statement. This is the report that shows if you made a profit or a loss. Depreciation shows up here as an expense. So for our bakery, that $900 in yearly depreciation makes our profit look $900 smaller. Now, even though it's a non-cash expense, it lowers your taxable income, and that's a big reason why businesses do it.
Now let's hop over to the balance sheet. This is your company's financial snapshot. Your oven is listed here as an asset. Every year, that depreciation amount gets added up, and it reduces the asset's book value. So after year 1, your $10,000 oven is now technically only worth $9,100 on your books.
So when you boil it all down, depreciation isn't really about what an oven is worth in the real world. It's a really powerful accounting tool that helps a business tell a much more honest and accurate story about its performance over many years. And this is just one of the many rules that shape how we read a company's finances, which kind of makes you wonder, what other stories are the numbers trying to tell us?